Hello viewers, thank you for tuning in. Once again, I'm your host, Mr. Spotter Fred, and we want to continue doing what we like doing most. And this is still advanced financial management. Fine, that's what we like doing most. Now, friends, from the previous sessions, we have been dealing with mergers and acquisition. So it's just a continuation of mergers, and acquisition. As we promised, today's session may be the last session, and we want to deal with some more examples of mergers and acquisition. We want to look at one more or two more examples of merger and acquisition. One of the examples we'll be looking at is a question that was examined in December. In December 2011, question 3. Friends, this is our illustration 5. This is our illustration 5. That is our illustration 5. We have done, this is the 5th illustration. So it means that we have had a very good experience in this area. Now, in this illustration, we are saying, it is a question B. Double Limited is contemplating acquiring Tattoo Limited. The following information relates to Tattoo Limited. For the next 5 years, we have year 1, 2, 3, 4, and 5. We have the net sales, cost of sales, selling and admin. We have interest expenses. Additional information 1, after the 5th year, the cash flows available to Double Limited from Tattoo Limited are expected to grow by 10% per annum in perpetuity. 2, Tattoo Limited will retain 40 million shillings for internal expansion every year. 3, the cost of capital can be assumed to be 18%. 4, the applicable corporate tax rate is 30% required. Roman 1, the estimated annual cash flows of Tattoo Limited. Roman 2, the maximum amount that Double Limited will be willing to pay to acquire Tattoo Limited. That's interesting. It's another dimension of what we have been doing. Roman 1, the estimated annual cash flows of Tattoo Limited. What are the annual cash flows of Tattoo Limited that is about to be acquired? Then Roman 2, which will be important, however, will take into account what we have done in Roman 1, the maximum amount that Double Limited will be willing to pay to acquire Tattoo Limited. Now, the maximum amount that Double Limited will be willing to pay is simply the total present value of the total cash flows, the total present value of all the cash flows. That if they pay more than the total present value of all the cash flows, then the project would be unacceptable. It means it will yield a negative NPV. So the maximum that we can only pay is the amount that if we pay, it will be equal to the total present value, in that the NPV will be 0. So that's exactly what we are required to remember here. Now, we go back to this additional information. That after the 5th year, the cash flows available to Double Limited from Tattoo Limited are expected to grow by 10% per annum in perpetuity. Fine, it means at the 5th year, there will be perpetual growth. Then 2, Tattoo Limited will retain 40 million for internal expansion every year. Now, you know, external expansion simply, that's a capital expenditure. So 40 million every year we are going to reduce. That is after tax, not before tax. After tax, we have to subtract the 40 million. 3, the cost of capital can be assumed to be 18 million, right? Then, 18%. Then the applicable corporate tax rate is 30%. So what we start with Roman 1? We start with our Roman 1. Roman 1, the estimated annual cash flows of Tattoo Limited. So we'll talk about we'll talk about the year 1, year 2, year 3, year 4, and year 5. We start with the net sales. We less the cost of sales. We less the selling and admin. We less the interest expense. Then after we less that, we get the profits before tax. Let me call this the profits or the cash flows before tax. We less our tax. We also less capital expenditure for expansion. Yeah, that's what we do. Then we are going to have the net cash flows for each year. So the net sales is 10. Our figures are in millions. We have the 1260. We have the 1510. We have the 1740. We have the 1910. Then we have the 735, 882, 1057. Then we have 1218. We have 1337. Then we have admin expense is 100, 120. We have 130. We have 150. We have 160. Then we have the interest expense. We have the 40. We have the 50. We have the 70. We have the 90. We have the 110. Then after that, we have the tax. We have the expansion is 40 million for each year. Perfect. So I take my calculator, say the first year, for example, 10, then minus 735, minus 100, minus 40. We have it as 91, 75. Tax is at 30%. Yeah, that's what I must have seen, 30%. So I multiply that by 2752.5. So I'll be able to have 9175 minus that answer minus 40. So we have 6382.5. Then we have to say 1260 minus 882 minus 120 minus 50. Right? That's minus 50. We have 208. There is tax of 0.3, 62.4. Then 208 minus that answer, minus 40. That's 105.6. Then we do for year 3, 1510 minus 1057 minus 130 minus 17. That's 253. Then we multiply by 0.3, 75.9. Then I come and say 253 minus answer. I subtract the 40, which will have 137. 137. Then we come and say 1740 minus 1218 minus 150 minus 90, 282 by 0.3, 84.6. Then we have 282 minus that, minus the 40, we have the 157 0.4. Then finally, year 5, 1910 minus 1337 minus 160 minus 110, 303. Then by 0.3, we have 90.9. Then we say 303 minus 90.9 minus 40, we have 172.1. So those are the cash flows that we have immediately after just the net cash flows. The net cash flows for each of the 5 years. Those are the net cash flows for each of the 5 years. We were asked the estimated annual cash flows of Tattoo Limited. That's the annual cash flows, the annual for the 5 years, but not the perpetual. We have the perpetual cash flows as well. We should remember that there is from fifth year onwards, there is perpetual cash flows. Perpetual cash flows, and that will be the 172.1 million will be in perpetuity, will grow in perpetuity, where we are going to remember this formula. You divide it by we divide by the costs minus this is amount over the KE minus G, and in that amount, this is the amount in the 5th year, amount in the 5th year, over the 18% minus the growth rate in perpetuity. It will grow in perpetuity 10%. So we are talking about 172.1 million over 0.8 minus 0.1. What will that be? So our perpetual cash flows will be 172.1 divided by 0.18 minus 0.1. So we get that as 2151.25. That's the perpetual cash flows, and we are going to discount them accordingly. Fine. Now, on that note, we now move on to Roman 2. Roman 2 is the maximum amount payable to acquire Tattoo Limited. The maximum amount will be equal to the total present value of all cash flows. So we cannot pay more than that. If we pay more than the total present value of all the cash flows, then it means that we are going to have a negative NPV. Now, on that case, we are going to discount the cash flows. We're going to discount the cash flows for the 5 years, including the one for perpetuity. So we come and say there is the year, there is the cash flows, there is the discounting factor, and there is the present value. The discounting factor is at 18%. 18% is at 18%. So we do that, and we are going to get the present value interest factor of an annuity, not of an annuity, R% n years. That's what we're going to do. Fine. The year 1, 2, 3, 4, 5. 5, there are 2 of them. So we have them there. This is 633, 63, 82.5. They're in millions. 105, they're in millions. Don't forget, they're in millions. 105.6, 137.1, 157.4, 172.1, then 2151.25. The discounting factor is 1.18. Remember, this one we need to take 1 plus r raised to n. Don't forget that. So we are saying 1.18 raised to -1. Then we have it as 0.8475. The next year, we don't, these are very powerful machine. We make our life easy. The answer we have there, we divide it by 1 plus R. That's 1.18. So we get that 0.7182. This being a powerful machine, now the third year, we just press equal. We get 0.6086. Now, we also say that these are very powerful machine. Even thereafter, you simply press equal. You will get the answer 558. Then thereafter, equal again. You'll have 0.4371. Then thereafter, again, equal 0. No, these will be the fifth year. They are the same. So we are using 0.4371. Remember, using a calculator is also another, is another business that we will talk about another day. Maybe some of you may not be good in using a calculator. As you have noticed, what I've simply done, the first year I took 1.18. I raised it to -1. That's just the normal one, 8475. So the second year I divided by 1 plus R, that's 1.18. I got the answer, 718. So the third year I pressed equal the fourth year, the fifth year equal, and that's how I was able to get them. Now I multiply those items. I say 6382.5. I multiply by 0.8475. Then that will bring to 5409, 0.17. These figures are in millions. The next one is 105.6 by 0.7182. Then I multiply that, I'll get 75, right? 0.84, fine. Then the next one is 137.1. I multiply that by 0.6086. So we get that as 83.44. Then we have 157.4. Then we multiply by 0.5158. Then we have 81.19. Then we have 172.1. We multiply by 0.4371. So that one I get it to be 75.23, somewhere there, rounding off. Then 2151.25 by 0.4371 in perpetuity. So that is 940.31. That's perfect. So we get the total maximum amount payable. The maximum amount payable, so I'll take that and say 5409.17 plus 75.84 plus 83.44 plus 81.19 plus 75.23 plus 95.31. I'm getting 6665.18. So this is simply shillings 6,665,180. That is the maximum amount Double Limited will pay for Tattoo Limited. They cannot pay more than that. If they pay more, they have a negative NPV. But if they pay exactly that, they will have a zero NPV. That's okay. So the maximum they can pay is that 6,665,000. Now we have come to the end of this question. We'll want to also try another question. We'll want to look at another example, another illustration. That's illustration number 6. Illustration number 6 is a question that was examined in June 2013. Now you see we are doing them, they're becoming easy. It's a question that was done in June 2013, question 5. That's our illustration number 6. Number 6A, explain the term value gaps as used in mergers. You know, value gaps is whereby there is a quotation that was made was not very correct, whereby the expectation and what was the actual value of that particular acquisition, there's a big difference, or there's a difference. Now that makes it to be called a value gap. Fine. Then discuss 4 factors that could give rise to value gaps in mergers. That's enthusiastic bidding, for example. We have enthusiastic bidding. That's one of them. We may have overbidding, right? Overbidding or enthusiastic bidding is the same actually. We may have poor corporate parenting. Poor corporate parenting is one of the reasons of the value gaps. Then we may have too much expectations. There are too much expectations of this particular merger. That is one of the reasons that we may have a problem with the value gaps. That is poor corporate parenting. We have already said that. So that is actually one of the reasons why we'll have the value gaps. Then question 7, question 5C. Texas Limited is considering making a bid for the entire equity capital of Vexas Limited. Vexas Limited has a price earnings ratio of 9 and a total earnings of 390 million. Texas Limited has a price earnings ratio of 13 and total earnings of 693 million. It is expected that 125 million of synergistic savings will be made as a consequence of the takeover. The price earnings ratio of the combined company is expected to be 12. Required minimum value accepted to Vexas Limited shareholders, right? Number 2, the maximum amount Texas Limited should consider paying. So what will be the minimum value acceptable to Vexas? Vexas is simply, from what we have read, Vexas is the one that is likely to be acquired, while Texas is the one to acquire Vexas. So the minimum amount that will be acceptable by Vexas will definitely must be the market value of the shares of Vexas. That they cannot accept less than the market value of the shares of Vexas. That is what we are looking at. Then the maximum amount Texas should be consider paying, it must not be more than the combined market value. The combined market value of Texas after acquisition. Now, friends, what we are going to do here in summary, in Roman 1, we need to compute the market value. The market value of Vexas. That will be the minimum amount they will want to accept. While in Roman 2, we'll want to compute the market value of the combined business. Let's go back to this information. We have been told that Texas Limited is considering making a bid for the entire equity capital of Vexas Limited. Vexas Limited has a price and ratio of 9 and total earnings of 390 million. So that Vexas, which acquired, has a price earning ratio of 9. The total earnings of 390 million. Now, from that point, it means the required Roman 1 will have already answered it. Because to determine the market value of Vexas, we simply want the price earning ratio. We multiply by the earnings of Vexas, and which is given there at 390. And then we are done. Texas Limited, the second paragraph, Texas Limited has a price earning ratio of 13 and a total earnings of 693 million. It is expected that 125 million of synergistic savings will be made as a consequence of the takeover. The price earnings ratio of the combined company is expected to be 12 times. So that's the price earnings ratio of the combined business. Very important. So we'll want to look at that, and we have the price earnings ratio of Texas, which is 13 times before, and we have the total earnings of 693 million. We also been given that there is 125 million of synergistic savings that will be made as a consequence of the takeover. The price earnings ratio of the combined company is expected to be 12. That's okay. Let's do our required number 1. Let's deal with the first one. Right? So we'll want to continue. We'll do that required number 1. Then we'll do required number 2. In our required number 1, we have been told that is a question that was done in June. Right? In June 2013, question 5. That's question 5C. The question 5C, This is our illustration. Your illustration 6. Remember, friends, we have done so many illustrations. This is the sixth one. We have been told that the minimum value acceptable to vectors. Roman 1, minimum value acceptable to vectors shareholders. The minimum value acceptable will be the market price of shares issued, of the market price of shares in Vexus Limited. And how can we get the market price? The market price of shares. The market price of shares, you need to remember, you need to recall this, that if you take our price earning ratio, will be market price per share over earnings per share, which is the same as market value of shares you divide by the total earnings. Then what will be the market value? Market value of shares is the price earning ratio. You multiply the earnings. If we do that, we are able to get the minimum. So the minimum amount, we add the price earning ratio, which is 9. We multiply the 390 million. And our maximum that we are going to pay, that Vexus will accept, is 390 by 9. So this is 3510. That's the maximum they are willing to accept. I mean, not maximum, the minimum they are willing to accept. So from that point, we'll want to now move on to Roman 2 and see and be able to see the maximum amount Texas will pay. They cannot pay beyond that amount because of space. Let me move to this other side. The maximum amount payable should be not more than the excess or surplus from the combined, from the market value of the combined business. We not more than the excess or surplus from the market value of the combined business. So what will be this excess? The excess or surplus after acquisition is equal to, we talk about the combined value, the combined market value after acquisition. We subtract the market value of Texas shares. That will be the excess. That the combined market value after acquisition minus the market value of Texas shares. And remember, when you talk of the market value with the kind of information given here, we are simply going to get the price earning ratio. The price earning ratio, we multiply by the earnings. You need to remember as well, for this, our combined earnings will be earnings earnings of predator, and target, plus the savings. There are some savings that we have there. So let's compute that. What will be the combined market value? The combined market value, we are going to have the price and ratio. You multiply the combined earnings plus savings. And this is further, we have been told very well there that the price earning ratio after acquisition will be 12. So 12, you multiply the combined earnings, which will be, there is 693 plus 390 plus the savings. Savings expected is 125. So what will that be? So I take my calculator and say 693 plus 390 plus 125. Then I multiply by 12. So we are getting 14,496. Then we less market value of Texas shares, so that we get the surplus. That will be, we were told that the price earning ratio for this is, we have been given something to do with the price earning ratio of 13. You multiply 693. So how much would that be? So I take 13, I multiply the 693. So that figure is 9M. All these are millions. So I subtract that. So what will be the excess? The excess will be 14,496, right, million, minus that. So it's 54,87 million. So that's an excess or a surplus out of the acquisition. So the surplus is 54,87 million. So we cannot pay, Texas cannot pay more than 54,87 million, because the 54,87 million is excess out of this merger or out of this acquisition. So if we pay more than 54,87 million, then we are going to make losses. So that's exactly the position that we were required to come to. Now, friends, we have done 6 illustrations. And I believe at this point, you have a good and a better understanding on how to go about mergers and acquisition. But don't forget, we normally also do revision. We have been doing revisions not only in our text, even in our videos. We have the revisions of 2014, 2015, and 2016, not forgetting 2017. So do not forget to also look at the revision or a block release when it comes to the right time. So I know you have enjoyed. You'll keep on enjoying. We are through with this topic. However interesting it was, we have to call it, we have to say it's over for now. Until next time, when we'll be doing revision. For now, we want to move on to a different topic. Thank you. See you next time when you won't avoid it. I know, friends, you'll not afford to miss.